As of this exact moment, live trading on the NASDAQ, Plug Power Inc., ticker symbol PLUG, is changing hands at $2.19, down approximately 1.10% or roughly 2.5 cents on the intraday session so far. While the broader markets are digesting macroeconomic data, what we are witnessing in Plug Power right now is not just a simple red day, it is a battle for psychological support at the critical $2.20 level that the bulls have been desperately trying to defend for the last 3 trading sessions. The expectation for many retail investors, the ones perhaps watching Tesla stock or Nvidia stock defy gravity, is that a company sitting at the center of the hydrogen economy should be finding a bottom here, especially given the global push for decarbonization. You hear the narrative constantly: hydrogen is the future, or this is the next Amazon of energy. But the reality, the cold, hard number flashing on your screen at $2.19 tells a vastly different and far more uncomfortable story. The reality is that the market is currently pricing in a severe liquidity crunch and a crisis of confidence that no amount of press releases about future capacity can immediately fix. We are watching a tug-of-war between the immense promise of green hydrogen and the brutal arithmetic of cash burn, and right now the arithmetic is winning. To understand why this stock is struggling to hold above that $2.20 mark today, you have to look beyond just the headline price and look at the order flow we are seeing on platforms like Interactive Brokers' trading dashboards, where institutional volume is painting a very specific picture. While you might have retail traders on the Robinhood app buying the dip, hoping for a quick bounce, the institutional money, the kind managed through Fidelity Wealth Management or sophisticated Schwab Intelligent Portfolios, is largely sitting on the sidelines, or in some cases, actively hedging against further downside. The volume today is respectable, hovering around the 23 million share mark already, but the price action is heavy. Every time the stock tries to tick up to $2.21 or $2.22, it gets met with a wall of sell orders. This suggests that there is a significant amount of overhead supply. Investors who bought in at $2.50 or $3 weeks ago who are just looking to get out at break-even or minimize their losses. This creates a technical ceiling that is very difficult to break without a massive catalyst. The tension here, the expectation versus reality, is palpable. The expectation is that Plug Power is a technology company, a growth innovator that should be valued on its future sales of electrolyzers and fuel cells. The reality, however, is that Plug Power is currently trading like a distressed asset. When you look at the financials, specifically the gross margins, which recently came in at a staggering negative 67%, you realize this isn't just about growing pains. It is about a fundamental disconnect between the cost to produce their product and the price they can sell it for. The market is punishing the stock today because there is no clear visibility on when that equation flips. If you were using a SoFi active investing account to screen for value, you might see the low share price and think, bargain. But a deeper dive reveals that the company is burning through cash at a rate that is alarming even for the high-risk alternative energy sector. We are talking about hundreds of millions of dollars per quarter vanishing into operational costs and capital expenditures. Let's talk about that cash burn, because it is the single most important phrase for any PLUG shareholder right now. In the most recent reports, we saw operating cash flow usage that suggests the company has a limited runway unless they raise more capital or drastically cut costs. This is why the stock is down 1.10% today, despite the broader tech sector, led by names like Apple stock, holding relatively firm. Investors are terrified of dilution. They know that for Plug Power to survive long enough to become the giant it promises to be, it might need to sell more stock, which dilutes the value of the shares you are holding right now. It's a classic death spiral financing fear. The stock price drops, so they have to issue more shares to raise the same amount of money, which makes the stock price drop further. This is the conversation happening in the boardrooms of Fidelity Investments and among high-net-worth clients using Interactive Brokers stock trading tools. Is PLIG a venture capital-style bet that might go to zero, or is it a mispriced asset that could double in a month? We have to address the elephant in the room, the Department of Energy loan guarantee. The expectation was that the $1.66 billion DOE loan would be the silver bullet, the moment where the government steps in, backstops the balance sheet, and allows Plug Power to build out its green hydrogen network without tapping the equity markets. The reality we are facing in late 2025 is far more complex. With the shifting political landscape and the transition hurdles in Washington, the certainty of that loan has evaporated. The news that Plug has suspended certain activities related to the loan due to this uncertainty is a massive blow to the bull case. It is the main reason we are seeing this slow bleed in the stock price. The market hates uncertainty more than it hates bad news. If the loan was definitely off the table, the stock would crash and find a new bottom. If it was definitely on, we'd be at $4. But being in this limbo state, where the loan is conditional but stalled, is torture for the share price. It keeps the Robinhood crypto crowd, who often overlap with high-risk stock traders, interested, but it keeps the serious capital away. Before we go further into the technicals of the Georgia plant and the specific electrolysis technology, I want to hear from you. Comment below how many shares of Plug Power you currently hold, and tell me, do you think the government will pass legislation in favor of the cannabis industry or the hydrogen industry first? It feels like both sectors are trapped in the same regulatory purgatory right now. Let me know your thoughts in the comments. Now, let's strip away the stock price for a moment and look at the company itself, because if you are holding this stock, you are owning a piece of a business, not just a ticker symbol. Plug Power is fundamentally an ecosystem play. They aren't just trying to sell you a fuel cell for a forklift, they are trying to control the entire hydrogen value chain. They produce the hydrogen, they liquefy it and transport it, and they manufacture the engines that use it, GenDrive. On paper, this vertical integration is brilliant. It reminds one of the early days of Tesla stock, where the goal was to own the car, the battery, and the charging station. The problem is that building the charging station equivalent for hydrogen, liquefaction plants, storage tanks, tanker trucks, is infinitely more capital-intensive and technically difficult than laying copper wire. The company's flagship project in Georgia was supposed to be the proof of concept that they could produce liquid green hydrogen at scale and at a profit. The expectation was that once this plant was online, margins would improve drastically because Plug wouldn't have to buy hydrogen on the open market at inflated prices to service their customers like Amazon and Walmart. The expectation has been a series of technical delays and efficiency issues. While the plant is running, it hasn't yet been the margin savior investors hoped. This is a common theme in online investing forums. Wait for Georgia. Now that Georgia is here, the goalposts have moved to wait for Tennessee or Texas. This constant shifting of timelines wears down the patience of even the most devoted long-term holders. But we must give credit where it is due. Plug Power has an incredible dominance in the material handling space. If you walk into a massive distribution center for a Fortune 500 company, there is a very good chance the forklifts zipping around are powered by Plug Power fuel cells. This is their bread and butter. It's a real business with real revenue. The value proposition there is strong. Hydrogen fuel cells charge in minutes, whereas batteries take hours or require swapping. For a 24/7 warehouse, that efficiency is worth paying for. But the stock isn't priced for a forklift company. It was priced for a global energy giant. The valuation multiple, even at these depressed levels, implies that Plug will successfully pivot to stationary power. backing up data centers, which is a huge narrative right now given the AI boom driving NVIDIA stock, and heavy-duty trucking. Speaking of data centers, this is the one contrarian angle that could actually send this stock ripping higher. We know that AI data centers consume massive amounts of power. The grid is struggling to keep up. Diesel generators are dirty and facing regulatory scrutiny. Hydrogen fuel cells are clean and offer the kind of reliable, always-on backup power that tech giants need. If Plug Power can announce a major binding partnership with a hyperscaler, a Google, a Microsoft, and Amazon AWS to power their data centers with stationary fuel cells, the narrative flips overnight. This is the lottery ticket aspect of holding PLUG. You're not holding it for the forklift sales. You're holding it for the potential that they become the backup generator for the